From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for July 8th, 2022. The Brewers are home this weekend with the Pirates, and then they hit the road for a week. It's also the third and final weekend of Summerfest with Rick Springfield and the Marshall Tucker Band, just to name a few. Music that'll take you back to your 8-track days. Okay, let's start in our own backyard. Pabst is celebrating 178 years of brewing PBR, and they're doing it in a big, big way. Not with a collectible 6 or 12-pack, but a giant 250-pack. That's 250 cans of PBR. It measures 4 feet by 3.5 feet and weighs in at a whopping 187 pounds. Don't forget your own forklift. And speaking of beer, how about a new beer from Singapore? It's a blonde ale made from recycled sewage and toilet water. Tastes great, less filling. I don't think so. In a small southern Mexican town, they hold an annual harvest celebration with the mayor getting married to an alligator. There's no interspecies hanky-panky here, but the alligator is dressed in white and gets her mouth taped shut, not necessarily in that order. Then the whole town throws a big party with singing and dancing and plenty of tequila. Except for the alligator, it sounds a lot like Summerfest. Worshippers are leaving the Mormon Church in record numbers. 3,000 ex-members have started the Divine Assembly. The sect considers magic mushrooms a divine sacrament. Apparently, in some parts of Utah, it's always 1969. And finally, Florida is under quarantine again, but not for COVID-19. It's because of giant concrete-eating African land snails. That's a mouthful. They're 8 inches long, lay thousands of eggs, and travel by attaching themselves to cars and trucks. The Department of Agriculture describes them as the most invasive pests on the planet. Welcome to Florida. Escargot, anyone? On the podcast today, we have Dave Sandstrom, Paige Radke, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. And a strong week it was. The NASDAQ up 4.6% this week, closing at 11,635. The S&P 500 up 1.9%, up 74 points this week to close at 38.99. And the Dow Jones Industrial Average up 0.8%, closing at the bell at 31,339 for the year. NASDAQ down 25.3%, still a rough year despite the strong week. The S&P down 17.6%, and the Dow Jones Industrial Average down 12.9%. You know, maybe a good place to start off with you this week, Joel. We got some news on the labor market. Clearly, with the conversations continuing to revolve around when the next recession comes, are we in the next recession, what's it going to look like, how bad's it going to be? Well, the labor market, I think, paints a pretty nice picture of at least one area of the economy that's still going pretty strong.
Yeah, Kyle, whether we're in a recession already, whether it's right around the corner, whether it's months away, the employment numbers are looking relatively healthy for those sorts of situations. So, we lost 22 million jobs back in February of 2020 after the pandemic outbreak, and now we're back above that unless you count government jobs. So private payroll, we're above where we were in February of 2020, which is astounding. That's 26, 28 months. Help me with my math here. So it's not that long compared to back in the Great Recession. It took us 76 months to recover all of the jobs we lost. If you count in the government jobs, we're still 0.3%, about 524,000 jobs shy of where we were in February 2020. But that's one measure of how well things are going. And then if you look at the other measure from the government report that we got today, unemployment rate, we're at 3.6%. We've been there for the last 4 months. And when the pandemic started, it was 3.5%. That was the lowest it was for like 50 years before that.
You know, Dave, we talk quite a bit about the employment picture and what it really means as far as the strength of the economy. You've looked at kind of the history of the labor market and you know, kind of the relationship that the labor market has to recession. I mean, clearly there's some stuff there that's pretty interesting to look at.
You know, Kyle, by the old technical definition, there's an opportunity that we could actually be in recession right now. We did have a contraction, a small one, in the first quarter, and projections are the second quarter may be in negative territory. And we always used to say that 2 consecutive quarters of negative GDP meant a recession. If that is the case, this is going to be a very unique one. To your point, we're looking at a situation where in all 12 of the recessions that we've had since World War II, the unemployment rate has increased by about 3.5% going into that recession. And here we are sitting on a decline since the December reading of last year till now. We're actually gone from 4% to 3.6%. So we've actually seen those numbers come down. Directly related that to, as well are monthly business payrolls. That is another area that's tracked for those watching for recessions. And in all of those recessions in the past, we've seen those payrolls decline by an average of about 3% monthly payroll. And in this year, we've actually had payrolls rising on average of 1.6% a month. So those things really fly in the face of recession. And so this would be very, very unique if, in fact, we hit those numbers.
Those are good points, Dave. And another report that we got this week were job openings. And there are 11.3 million job openings, and that's down 2 months in a row, which suggests things are cooling a little bit as far as the job market, but it's still near record highs. And if we look at the number of people who are looking for jobs, that's about 5.9 million. And then if you subtract that, you get 5.4 million. Well, in today's report, the government said that there are 5.7 million who are wanting to work and not looking for jobs right now for various reasons. 610,000 of them are because of COVID, because they can't, for whatever reasons, whether it's the sort of job they're looking for, or they can't get child care, or they can't get personal care, whatever reason. So if you do the math there, I mean, there's still some wiggle room for people who are looking for jobs, who could fill jobs for those jobs that are yet to be filled. And I think the bottom line for a lot of this is that it gives the Federal Reserve some wiggle room in what they're doing. If they're trying to cool the economy, they don't seem to have to worry about jobs as much as they might otherwise.
Well, and I think we need to be clear, of course, that the Fed has this dual mandate of inflation plus or price stability plus a full level of employment. And if full employment isn't the issue, then they can focus all the effort on the inflation card. And so, I think it's why as we look at all these data points, it's so important to remember, when we say recession, what we're really talking about is not, a rule of thumb. So often we go back to the rules of thumb of, 2 consecutive quarters of negative GDP growth. But the National Bureau of Economic Research, this group of economic researchers, really looks at a much broader set of data to get an understanding for where we truly are. And so, while we might hit the kind of rule of thumb definition here, depending on how second quarter GDP goes, Dave, I think you rightfully point out, as we look at the employment picture, this one could look very different. And as we look at some of the other measures out there, this recession, if it is a recession already, could be a very different one, and that could make it even more challenging to really pin down the definition this time around. Paige, I think as we look at the inflation piece, we like to talk in the stock market how about it's all about earnings and interest rates. It feels like for the economy right now, it's all about inflation and the labor market. We spent quite a bit of time talking about the labor market, but certainly inflation, the other piece of this that may now be starting to weigh on earnings reports from companies, may now starting to weigh on kind of our expectations for what the next few months look like. And so as we head into starting next week, second quarter earnings season, I think a lot to keep an eye on.
Yeah, Kyle, like you said, second quarter earnings season is just around the corner. And at this point in time, corporate management, business models, those types of things are going to be increasingly important in how those earnings shake out because we're dealing with this time of economic uncertainty. So how are companies dealing with things like higher inflation, shifts in consumer spending, we went from services to goods, we're shifting back to services, and just a general volatile supply environment, largely because of, persisting problems from the pandemic. Of course, you got the war in Ukraine and all the issues that has caused, still concerns about lockdowns in China. And at this point, analysts' consensus estimate is 10.4% higher revenue and 5.6% earnings growth. But when you exclude energy from that picture, so the big piece, we're all talking about higher gas prices, sales are actually expected to decline a little bit by about 2.4%, earnings increase a little bit, but we are starting to see some pressures on profit margins. Growth may be slowing, and so the real question right now is, as we start to get these new earnings numbers, will our expectations for the second half of the year continue as they are? And that's going to have impact on valuations and things like that. So the big thing that I'm going to be focusing on not only is what have they done so far this last quarter, but the forward-looking guidance. And I'm really looking for corporations to start talking about how they're managing some of these issues rather than just focusing on the fact that they exist.
And some expectations potentially the dollar strength starts to make its way into some earnings reports as well. Remember that if there's concern globally about volatility, and if the U.S. has already raised interest rates in anticipation or in response to inflation, those things both combine to make the U.S. dollar more attractive, right? And so for non-U.S. purchasers of U.S. goods, and specifically thinking S&P 500 type companies, about 40% of S&P 500 revenue comes from outside the U.S. Well, all of a sudden that 40% of revenue becomes more expensive. So real impacts to the strength of the dollar here.
Exactly. I mean, if you look at right now, the U.S. dollar has, pushed relative to other currencies higher than it's been in a very long time. So the euro has neared a 20-year low against the dollar. We're almost reaching parity, which means that it's a 1-for-1. Our currencies are worth the same, which hasn't happened in quite a long time. But the dollar also rose against some of the other more safe currencies like the Japanese yen and the Swiss franc. So there's lots of other things at play. The higher interest rates is more appealing to other investors. So we have a lot of money funneling in there, which ultimately is to some extent keeping a cap on the long-term interest rate. But the big thing is, overseas earnings for U.S. companies are going to be less valuable. It's going to be harder for those overseas companies to pay back their dollar-denominated debt. So especially when we have all these other issues going on, the strong dollar is a big issue right now. But ultimately, longer term, the dollar has been strong for so long, and it all comes back to that corporate management. So the hope is that companies are able to look at this dollar strength and find ways to continue to make money, continue to push those profit margins. But like I said, it just comes all back to the importance of good companies, not just companies trading on the market.
Well, and I think so often you hear that the dollar is stronger, or you hear dollar strength, and you think, oh, what a great thing. USA, it's the 4th of July this week. Certainly lots of fireworks shot off in my neighborhood. But remember that dollar strength doesn't strictly mean that it's better for U.S. businesses, for U.S. consumers. You want to travel to Europe, you want to travel to Japan, you want to travel to other places. Maybe it's a little more affordable right now, but the reverse of that is also true, that non-U.S. individuals and corporations trying to buy here in the U.S. have those problems.
Yeah, but it's also important to note that strong dollar isn't all bad. Traditionally, a strong dollar means lower commodity prices, so that's been a big piece of the inflation picture that we've been looking at recently. We haven't seen that impact on commodities quite yet, but it could be coming. And also, just looking U.S., small cap and mid cap companies here in the U.S. have not been this cheap in a long time. They've been a lot more volatile, so I think investors aren't too excited to jump into those right now, but they're cheap and they're a lot more insulated from that strong dollar than those multinationals.
Great points, Paige. Dave, as we kind of look ahead the next couple of weeks, big pieces of data coming out. Next week we've got reports on producer prices and consumer prices. Got a second quarter GDP report later in the month. And, at the same time, this tends to be the time of year in which, a lot of traders take vacation, a lot of, the market volatility, or at least the market volume, tends to slow down a little bit. And so, I think there's this kind of competing interest right now between all this really important information that's out there and, maybe some of what would otherwise be a slower time of year. Add in what Paige was talking about earlier with, kind of the earnings expectations. And I think, maybe a pretty interesting time to kind of look ahead to what's coming.
Yeah, Kyle, I'm certainly paying attention to these inflation reports. I think that's really going to be driving the bus for the rest of the summer. We talked about, the importance of interest rates as it relates to investors and valuations of stocks. And it's very difficult for analysts and investors to get a handle on that when the Fed is really committed to stopping this inflation. And that means they're going to keep raising rates until they do. And I believe they're committed to that. And so these inflation reports that are going to come out monthly, it's going to be critical to see a downward trend at some point. We're going to need an opportunity here for the Fed to kind of take a step back at some point and say, hey, look at what we're doing is working. Raising rates has cooled things. We're seeing the inflation numbers start to decline. And maybe we can take a step back now and refer back to data as we move forward. That'll take a lot of pressure, I think, off of investors trying to guess at where the ceiling of interest rates is headed.
And Dave, it makes me wonder, the Fed's been criticized for being slow to raise rates, and I wonder if they're going to be hesitant to stop raising rates, if how much data they need, how long they need to look at this to feel comfortable to say this is where we want it.
And I'm really actually kind of glad that they accelerated the pace recently. This whole concept at the beginning of we're going to do a quarter point increase for the next 10 months, it's kind of a death by 1,000 paper cuts kind of a situation. So, where it got a little painful there when they announced the 0.75% increase last time, and they may do it again. I think we get to that end game a little quicker, and gives them maybe that opportunity to maybe take a breather a little quicker. So I think it's good that they've accelerated the pace.
I had some clients in from New Berlin earlier today, and we were talking about the Fed, and I told them, on your way home, get on the highway and drive in reverse all the way home at 70 miles an hour and tell me how easy it is. And that's what the Fed is dealing with, right? They're constantly looking in the rearview mirror at what has happened, right? All the data they have isn't necessarily a forecast of where we're going. Sure, they can do some of that, but it's only as good as the data they're using to do it. And that data is all looking back a month or two at what's already happened. And so if you don't know the impact of what you're doing until a couple of months down the road, you're driving in reverse pretty much the whole way home. And so I don't envy the job they have. Certainly, Dave, I think you're spot on that it needed to go a little faster. Maybe the risk of driving in reverse is that you got to do it for a while if you don't get it over with. And so you drive a little faster just to get the risk out of the way. Of course, maybe not a great idea if you're driving home from downtown Milwaukee to New Berlin.
I hope they got home safely.
I'll give them a call later. But certainly, if you're the Fed, just trying to get some of that pain out of the way and then turn around and go, okay, how did we do? Right? And maybe you went a little too far and you go, okay, well, we can always trim a little. We can always find other ways to stimulate. Or what we've seen so far, maybe you didn't go far enough and you got to take another step. And so, I think, again, don't envy the job the Fed has. Don't envy, what they're trying to do. This dual mandate is never an easy thing, and they always seem to miss one direction or the other. And so, I think we can be a little patient, and we have been, but, we got to start to see the results here. Joel, as we look at some of the other economic data this week, certainly plenty of things to talk about, but what particularly stands out for you?
A couple of consumer numbers. So we know that consumer spending drives 2/3, 70% of the GDP. So there were numbers in the trade deficit report for May in which the consumer imports went down $1.5 billion. So that's suggesting that consumers aren't buying as much, and that is one of the effects that raising interest rates will do is that consumers will, stop spending as much and the economy will slow down. At the same time, factory orders came in for May, and consumer goods orders went up like 2.9%, which was a lot. So you've got those, sort of contradictions or juxtapositions. There was, we got a word late today on consumer credit use, specifically credit card use, and that's been up for 12 months in a row. It went up 8.1% in May on an annualized basis. So that's kind of a lot. And one of the things about that is that it indicates so people are using their credit cards and they're not paying them back right away, and that's an indication of consumer confidence. So even though we've got consumer confidence reports that are showing that they're at all-time lows and that consumers are really skittish because of high prices, we're seeing other data where they're still spending and they're still borrowing money to spend. So all sorts of interesting, seemingly contradictory things out there, but they're all within the realm of saying that the economy is still relatively healthy right now.
Yeah, and I think that week to week we tend to see some of that discrepancy, right? And as you start to look at broader trends, that's where the story really starts to emerge. Well, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.